Okay. Um, Welcome. Um, Good day, wherever you are listening to this class, watching this session. Okay, very well. We have discussed debt valuation and analysis. In there, we discussed cost of debt, market value of debt. Now, we want to move into cost of capital. Cost of capital. Cost of capital. Okay, cost of capital. Now, when we say cost of capital, what do we refer to? We refer to cost of debt. We're referring to cost of debt. That is KD, discussed it. We're referring to cost of equity. That is KE. Okay. We are referring to cost of preference shares, KP. Okay. Then lastly, we're referring to weighted average costs of capital. That is WACC, weighted average cost of capital. So that is WACC. Now, we refer to all of this as cost of capital. The combination of the first three, the combination of the first three is the last one. Okay, so we have discussed cost of debt. In there, we have also discussed cost of preference shares. All right, preference shares is an irredeemable debt. So we'll discuss how to calculate cost of preference shares. So now our major focus here is going to be the calculation of cost of equity and weighted average cost of capital. Now, moving on, if we are calculating cost of capital, whenever we are in the exam, an examiner is referring to cost of capital. When they refer to cost of capital, they are speaking of WACC, weighted average cost of capital. That is what they are always speaking of. And WACC has two risks. WACC always have two risks, at least one. Okay, the first risk is business risk. If you don't call it that, we can call it operating risk. Operating risk. Or we call it inherent risk. Okay, so the names we call now business risk is the risk you face because you trade in a particular industry. What do? You are a fashion designer, or you tailor, you are a stylist, you have risk in your own line of business. Every sector, every business has its own risk. So whatever risk that is inherent to the business or in the sector, that's what we refer to as business risk or operating risk. On the other side, we have what we call financial we have what we call financial risk. All right, financial risk. Financial risk happens because a company has debt in its capital structure, and the people that are claiming that they are facing this financial risk are equity holders, that is shareholders. Because when anything happens in the company and maybe the company wants to settle capital providers, they would answer shareholders first. And you must have noticed it when you are preparing a normal profit or loss account, starting from revenue, cost of sales, gross profit, administrative expenses, and marketing expenses, and all that. Then you have profit before interest and tax. Then you deduct interest. So you have already paid interest, all right, paid debt capital holder, a debt holder before paying dividend. So after that, after paying interest, you pay tax. After tax, after from profit after tax, you now pay dividend. So what we are saying is that you attend to debt holders first of all before you attend to equity holders. Even in the case of liquidation, company they settle debt holders first, and most times in liquidation, shareholders don't get anything. Okay, shareholders don't get anything, but even debt holders or other creditors don't get everything they deserve, but they will still get something. Or in the case of liquidation, so that is why shareholders feel that, oh, once their company have debt, they are going to be paying more attention to debt holders than them. So that is why they say they are facing financial risk. So these two risks will be there if the company have debt in its capital structure. Okay, but if the company do not have debt in the capital structure, it is only business risk that will be present in the case of the business, and we factor it inside the calculation of cost of capital, which is WACC. Okay, very well. Now, what is WACC? WACC, it is equal to KE VE divided by VO plus KD VD 1 minus T divided by VO plus KP VP divided by VO, and so on. Now, so you can see each section is demarcated with plus sign. So it shows that that is each source of capital. All right. Now it depends on how many sources of capital the company have. All right. But in the case of question, I don't think examiner will go beyond 3 sources of capital. All right. So let us say what do we have? Where KE stands for costs of equity. Okay, KD stands for cost of debt. Cost of debt. Okay, cost of debt. KP stands for cost of preference shares. Okay, cost of preference shares. Okay, now VE stands for market value of equity. Okay, VD stands for market value of debt. Okay, VP, sorry, this one I said KP, it is VP over VO. VP over VO, not VE over VO again. So it is VP, value of preference shares. So VP is market value of preference shares. market value of preference preference shares. That's VP. Okay. Excuse me. Okay. Okay. What else? Then VO. Okay. Let me write it here. VO. VO is corporate value. That is the total market value of the company, which is equal to VE plus VD plus VP, or the market value of the sources of capital, all add together. That gives us the VO. So this is how we calculate weighted average cost of capital. So from the side of debt, starting from KD, VD, KP, we have discussed that one. We're talking about debt analysis. So our focus here, VE, we are going to talk about this when we're talking about business valuation. Our focus here is KE, which is cost of equity. Okay. So in calculating cost of equity, KE, we use three methods. Method number one, we use capital asset pricing model. We use dividend model. We use dividend model, and we use Miller and Modigliani M&M model. Miller and Modigliani model. Okay, M&M. Okay, very quickly. Now, we are going to learn these methods one after the other. So we start from capital asset pricing model for calculating cost of equity. Okay, using capping, we call it capping, capital asset pricing model. Capping says costs of capital, it is equal to risk-free rates. Risk-free rate plus risk premium. That is how to calculate cost of capital. And now, let me now demonstrate it in the formula. Okay, Capping gave us two formulas. We're going to pay attention to two formulas. KEG, it is equal to RF plus BE, RM minus RF. KEU, we have RF plus BA, RM minus RF. Now, where KEG is costs of equity of a geared company. Cost of equity of a geared company. That is a company that is geared, their cost of equity. How do we know a company that is geared? A company that is geared is that company that has debt in its capital structure. So it is a geared company. KEU is cost of equity of an ungeared company. Cost of equity of an ungeared uh, company. Okay, so what about the next one? Let's say RF. I move to the next slide. RF. RF signifies risk-free rate. Okay, what else do we have there? We have RM. RM signifies market return or return of the market return. Then what else do we have there? We have BE. BE is beta equity. Beta equity or equity beta. Beta equity or equity beta. BA is beta assets. Beta asset, or you call it assets beta. Then we also have RM minus RF altogether. This is referred to as equity risk premium. Equity risk premium. So we have to watch out if what is it the examiner give us equity risk premium or they give us market return. If they give us equity risk premium, we just put a figure. That's they're giving us whatever is bracket. But if they give us market return, that means they just gave us RM. Okay, that means they just gave us RM. Okay, I'm sorry about that. Now, okay, after looking at all this formula, if you go back to the capping formula, KEU, the cost of equity of an ungeared, KEG, the cost of equity of geared. In two formulas, the difference is the beta, BE, BA, all right, beta equity, beta asset. So let's quickly discuss beta. Beta measures risk. Beta measures risk. And we have basically two types of beta will be discussed. Well, we have three. We have beta assets. We have beta assets. We have beta debts or debts beta. And we have beta equity. Okay, beta assets, beta debts, and beta equity. But emphasis will be only on beta asset and beta equity. Okay, so beta asset, beta asset measures business risk, which is our operating risk. It measures only business risk. Okay, and it is used for ungeared companies. It is used for ungeared companies, also known, right? It is also known as ungeared beta. just in case examiner say calculate ungeared beta. So it measures business risk. You can see when I was explaining cost of capital the other time, I mentioned something about business risk. So in the capping way, how do we measure business risk? We calculate beta assets. The second one, beta equity. Beta equity measures both the business risk, both the business risk and financial risk. It measures both the business risk and financial risk. Okay. It is used for geared company, a company that has debt in their capital structure. Ungeared means they don't have debt in their capital. It is also known as geared beta. It is also known as geared beta. Okay, so these are the differences between beta debt measures risk associated with debt. Okay, so we don't always be emphasis, but let us move on. So as for beta equity and beta assets. So we have the formula for beta assets. Beta asset is equal to beta equity times value of equity divided by value of equity plus value of debt plus value of debt 1 minus tax. So beta equity, BE is beta equity, VE, we are already aware that market value of equity. All right, this is it, plus beta, let me write, plus beta debt times value of debt 1 minus T divided by value of equity plus value of debt 1 minus T. So this is the formula for beta assets. Don't worry, examiner will give this formula, all right? You just need to know when and how to use it. Okay, now the second one, which is beta equity formula, cost of beta assets plus beta assets minus beta debt, value of debt 1 minus tax divided by value of equity. Okay. Okay. So this is the market. This is the formula for beta equity. Formula for beta equity. Formula for beta equity. Okay. Now let us look at the next phase of this discussion of principle. Now, I will say that notes if beta debt is not given, assume it is 0. Therefore, debt is risk free. Okay, debt is risk-free. Then beta assets, beta assets will be beta assets will be equal to beta equity times equity, where the value of equity plus value of debt, 1 minus tax. So plus 0. So the other side will be 0. If you look at the formula for beta asset, the formula for beta asset, you will see that the other side where we have beta debt times value of debt. So if beta debt is 0, that side 0 times 0 is 0. 0 divided by 0 is 0. Okay. So now, so that is why we calculate it. We calculate it in this manner. Okay. Now, very quickly, I want to share steps to calculating risk adjusted. Okay, risk adjusted or project specific or risk adjusted or project specific or suitable or appropriate cost of or appropriate cost of capital or appropriate cost of capital. Now, what are the steps? Step 1, get proxy. Step 2, on gear. Now, let me explain, go back to step 1. In step 1, when you are saying get proxy, you are getting a proxy. Okay, what do we know about risk adjusted cost of capital? Why? Or project specific. Project specific. What we are referring to there is that, yes, you have a company. The company is already producing flour. All of a sudden, you want to start producing sugar. Flour industry is different from sugar industry. So to do that, you want to appraise the project. So we believe that the business risk of flour industry that you are currently doing is going to be different from the business risk of sugar. Meanwhile, the cost of capital that you already have now contains the business risk of flour. So that is why you cannot use the current cost of capital you have, because it has the business risk of flour. Remember, we have discussed cost of capital. We said it contains business risk. Your cost of capital will have business risk inside of it. So the business risk of flour is what you have in the current cost of capital. That you need to readjust, okay, risk adjusted. You need to adjust the risk of that cost of capital to reflect the risk of the new industry you are going to, which is sugar. So we now believe that, okay, you've not been in the sugar industry before, but there are some companies who are producing sugar before, whether locally or abroad. Okay, you get their data, you use them as proxy, you use them to estimate the business risk that is inside sugar industry. So that is why we say you are getting proxy. For exam's sake, so proxies are the companies that are already doing the business you are about to go into, the new one you are about to go into. Okay, so for exam's case, just look for proxy, get the information. You are just getting the information. Identify, oh, this is a proxy inside the question. start writing the information concerning proxy that you need on ground. That's why I'm saying get proxy. Step 2, you ungear. Now, it is possible that when you are getting proxy, three basic things. You will get the beta equity of the proxy. You will get the value of equity of the proxy. You will get the value of debt of the proxy. Three basic things that you are going to get. So this beta equity, please pay attention to this explanation. It's important. This beta equity that you got from proxy, it is beta equity. What does beta equity measures? What does beta equity measures? Like I said here, and I said beta equity measures both the business risk and financial risk, meaning that inside that beta equity, business risk is inside, financial risk is inside. So, and what you are only looking for is the business risk. Okay. Now, that is why the financial risk, the level of their financial risk may be different from your own. So, which is the reason? Which is the reason you have to remove the proxy's financial risk away from the beta, away from the beta that you got, okay, which is the beta equity. So we are going to remove the financial risk from inside. So this beta equity we got from proxy, you are going to turn it to beta asset. That's why we say the step 2 is on gear. You are ungearing the beta. You have gotten the geared beta equity. You want to ungear it. So if you want to ungear it, what do you need? You need beta. You use let me say this. Use beta asset formula. Use beta asset formula and proxies information So that's what you're going to do. So when you do step 2, you move to step 3. Step 3 says regear. You picked a geared beta from proxy. You turn it to ungeared beta. We are now saying turn it back to geared beta. Why do you want to turn it back to geared beta? Simply because the project to contain, it's going to be financed by debt as well. Remember, that means the project is going to be a geared project and it's going to be financed by debt. Remember, beta equity, financial risk is inside beta equity. Financial risk is there in the financing mix. Okay, so that is why you are going to regear. Now, I'm now saying use in the regear, use beta equity use beta equity formula and the main company information. Use beta equity formula and main company's information. Step 4, you are going to cap it. So in step 5, you have already gotten beta equity. The beta equity you got in step 5, you will now put it in capping formula, which is KEG, cost of equity geared, which is equal to risk plus beta equity that you got in step 3, market return minus risk free. So that is the premium. I told you, cost of capital will say that the cost of capping will say that the cost of capital should be equal to risk-free rate or return plus risk premium. So the risk-free rate plus the risk premium. You can see that we are adding multiplying the premium by beta. We are trying to factor in the risk into the calculation. All right, that's why we are multiplying it by beta. So step 4, there are 5 steps here. Step 4 would be WACC. Sorry, step 5. Step 5 will be WACC. That's why. So how is it going to be? WACC is equal to KE, I've written the formula before, VE divided by VO plus KD VD 1 minus T 1 minus T divided by VO. Okay, let me write my 1 minus T. Let me write my formula very well. Okay, I say VD 1 minus tax. T is tax rate divided by VO. Okay, plus and so on, depends on how many you have. Different shares there, anyone, okay, bank loan, anyone. Okay, so this is WACC, meaning that the cost of equity you got in step 4, you are using it in step 5. I repeat, step 1, you get proxy. You have beta equity and other information from the proxy. Step 2, all those information you use it to calculate beta assets. Step 3, the beta asset you got in step 2, you use it to calculate beta equity in step 3. Step 4, the beta equity you got in step 3, you use it to calculate cost of equity geared in step 4. The cost of equity that you got in step 4, you put it in WACC formula, which is the cost of equity in step, which is cost of capital in step 5. Now, please, we're going to, in the next session, or the next video, we'll look at an exam question, a past question, and solve the question from it. But please, I don't want a situation, I want to advise, this is not a situation whereby you cram the steps, because understanding of the step is what matters. So let me quickly explain it so that I will reiterate the understanding of the step. Step 1, you are getting proxy. Why are you getting proxy? Because you are starting a new project that you have never been. Okay, I just said that you produce bottled water, but you want to start producing fruit juice. The industry of bottled water is different from the industry of fruit juice. Therefore, the business risk in bottled water is different from the business risk in fruit juice. So maybe you are a bottled water company for a long time. You know your cost of capital, you know your cost of equity, you know everything. Now, what is going to happen later if you want to? So the business risk of bottled water is already inside the cost of capital that you have. Now, if you cannot use that same cost of capital to appraise the project of fruit drink or fruit juice. So you now need to calculate a separate cost of capital to bring in business risk of fruit juice into it. That's why you see. So through the proxy, you get the risk of fruit juice already. Fruit juice before. So don't go off anytime. All right. Then step 2, you carry the beta equity, you ungear it, turn it to beta asset, which is the business risk that you are looking for. Step 3, because the project you want to do is going to be financed by debt, so that is why you need to regear the beta equity back to beta, and the beta asset back to the beta equity.